Picture two people, same income, same age, same amount of extra money sitting in their bank account at the end of every month. One puts it all toward paying off their debt. The other invests every single dollar while making minimum payments. 20 years later, one of them is quietly, significantly wealthier than the other. And here is the uncomfortable part. There is no single right answer to which one made the smarter move. The answer depends entirely on one number that most people never stop to calculate. And once you understand what that number is, you will never look at your finances the same way again. Welcome back to the Wealth Metrics. Today, we are getting into one of the most debated questions in all of personal finance. Do you pay off your debt first, or do you invest? We are going to kill the generic advice and give you a real framework based on real 2026 numbers. If you search this question online, you will find two completely opposite camps. One side says debt is a prison, and you should escape it before you do anything else with your money. The other side says the stock market grows at 10% a year, and every dollar you throw at debt is a dollar that will never compound for you. Here is the thing. Both arguments are mathematically correct in specific situations, and both are completely wrong in others. The advice that is right for someone with a 22% credit card balance is the exact opposite of what is right for someone with a 3% mortgage. People hear broad advice designed for a different debt situation than theirs and apply it anyway. They end up making a financial decision that costs them thousands of dollars over time, without ever knowing it. The number you need to know is the interest rate on your debt. That is it. That single variable determines whether paying off debt or investing is the mathematically superior move in your specific situation. Not your income, not how the debt makes you feel, not what your parents told you. The interest rate. Here is the logic. When you invest in a broad market index fund tracking the S&P 500, history tells us what to expect over time. According to data updated through early 2026, the S&P 500 has delivered an average annual return of approximately 10.1% over the last 100 years with dividends reinvested. Now here is where it gets interesting. When you pay off debt, you are effectively earning a guaranteed return equal to whatever interest rate that debt carries. If your credit card charges you 21% per year, paying it off is the financial equivalent of earning a guaranteed 21% return on that money. No investment on earth can promise you that with certainty. So the math becomes a simple comparison. If your debt's interest rate is higher than what you would realistically earn investing, you pay off the debt first. If your debt's interest rate is lower than your expected investment return, investing wins. If they are close to each other, you are in what we call the gray zone. We will get to that shortly. Let's look at the actual rate landscape right now. In 2026, the average credit card interest rate sits at approximately 21% APR. According to the Federal Reserve's most recent quarterly data, some cards go even higher. For rewards cards and borrowers with lower credit scores, rates climb to 24, 28, and even 34% in some cases. New card offers in June 2026 are averaging around 23 to 24%, meaning millions of Americans are carrying balances at rates that are historically punishing. Now compare that to what the stock market returns. The S&P 500's long-term average is around 10% annually. Adjusted for inflation, that number drops to closer to 7% in real purchasing power terms. Even using the optimistic nominal figure of 10%, a 21% credit card rate still beats it by more than double. This is not even a close comparison. The math overwhelmingly favors paying off credit card debt first. For the average American carrying a credit card balance in 2026, eliminating that debt is one of the highest return financial moves available to them. There is no stock, no index fund, and no savings account on earth offering a guaranteed 21% return. Paying off a 21% credit card is the closest thing to a risk-free, guaranteed return that most people will ever find in their financial lives. Now, let's look at student loans, because this is where the decision starts to get more nuanced. Federal undergraduate student loan rates for the 2025 to 2026 school year came in at 6.39%. For graduate students, that number climbs to 7.94%. For Parent Plus loans, the current rate sits at 8.94%. And for the 2026 to 2027 academic year, all of those rates are ticking slightly higher again. At 6.39%, the stock market's long-term average of 10% is higher, which means investing could come out ahead mathematically. But when you factor in taxes on investment gains and the reality of market volatility, the answer becomes genuinely less clear. Add in the psychological weight of carrying debt for decades, and you are squarely in the gray zone. Then there are mortgages. Many existing borrowers in 2026 are sitting on rates between 6 and 7%. If your mortgage rate is between 5 and 7%, you are right in the gray zone. Below 5%, the math shifts clearly toward investing. Above 7%, extra payments start looking more attractive again. Let's spend a moment on this idea of a guaranteed return, because it is the most powerful concept in this entire video. When you invest in the stock market, your expected return is not guaranteed. The market can drop 30% in a single year. History shows the market recovers and grows over long periods. But in any single year, or even any single decade, returns are entirely unpredictable. Paying off debt operates completely differently. When you send an extra $500 to a credit card charging 21% interest, you are saving yourself 21% per year on that $500, guaranteed, with zero risk of loss. That return does not fluctuate. It does not depend on earnings reports or Federal Reserve decisions. It is locked in the moment you make the payment. Bankrate ran the math on this. Clearly, a $5,000 credit card balance at 20% interest, paid off with minimum payments only, takes roughly 23 years to eliminate. And over that time, you pay approximately $7,723 in interest charges alone on top of the original balance. That is not just a debt problem. That is a 5-figure financial leak compounding against you every single day. The reason most people do not feel this pain is that it happens slowly and invisibly. Your statement just shows a manageable minimum payment due, and that number feels fine, which is exactly why so many people stay trapped in it for years. Let's make this practical. Here are the 4 most common debt types Americans carry in 2026, with the framework applied directly to each one. First, credit card debt. Average APR in 2026 is roughly 21%, and new card offers average even higher. The math is not ambiguous here. If you have a credit card balance, paying it off should come before investing anything beyond your employer's 401k match. Second, auto loans. The average new car loan rate in 2026 sits between 7 and 9%, depending on your credit score and loan term. This is in the gray zone, but leaning toward debt payoff. A 7 to 9% guaranteed return from eliminating your auto loan is competitive with market returns on a risk-adjusted basis. Auto loans are also amortizing, meaning your interest cost is front-loaded in the early months. Paying them down faster saves more than people realize. Third, federal student loans. Undergraduate federal rates are around 6.4% right now. At this range, the expected long-term market return of 10% does edge out the debt rate, which means investing while making standard payments is a defensible position. However, the size of most student loan balances and the multi-decade repayment horizon makes this as much a personal decision as a pure math one. Fourth, mortgages. If your rate is below 5%, the math strongly favors investing over making extra mortgage payments. You are borrowing money at a low rate and deploying it into an asset that has historically earned significantly more over time. If your mortgage rate is between 5 and 7%, you are in the gray zone. Above 7%, extra payments start to look more attractive. Mathematically, before we get to the gray zone strategy, there is one exception that applies to almost everyone regardless of their debt situation. Always capture your employer's 401k match first. Always. If your employer matches contributions up to 4% of your salary, that matches an immediate 50 to 100% return on your money. No debt rate on earth competes with that math. Here is what it looks like with real numbers. If you earn $60,000 per year and your employer matches 4% dollar for dollar, That is $2,400 of free money sitting on the table every single year. Over 30 years at a 10% average annual return, that uncaptured match compounds into over $400,000. Leaving it on the table to pay off a 6% student loan faster is one of the most expensive math errors a person can make. Think of capturing the employer match as step 0. It exists before the debt versus invest decision even begins. Now, let's talk about the gray zone in detail. This is the interest rate range, roughly between 5 and 9%, where neither paying off debt nor investing is obviously correct. The first thing to understand is that in the gray zone, either choice will work mathematically. You are not going to ruin your financial future by going either direction. The second thing to understand is the concept of risk-adjusted returns. A 7% guaranteed return from eliminating your auto loan is not the same thing as an expected 10% return from the stock market. The stock market can and does deliver negative returns in any given year. The S&P 500 fell roughly 19% in 2022 alone. Anyone who needed their money during that window did not earn 10%. They lost money. For people in the gray zone, the most sound approach is to do both simultaneously, but not equally. Allocate a larger share of your extra money toward debt payoff and direct a smaller share into investing so you keep compounding time on your side. A 60-40 split toward debt in the gray zone is a reasonable starting point. You reduce your liability while still building your investment base at the same time. Here is something that does not show up in any interest rate calculator. Debt has a documented psychological cost. Research consistently shows that people carrying significant debt tend to spend more impulsively and save less consistently. The weight of ongoing debt creates a feeling of financial hopelessness that distorts other money decisions too. If you are someone who lies awake at night thinking about your debt, that is a real cost not reflected in a 7 versus 10% comparison. The psychological freedom of eliminating a debt sometimes unlocks financial behaviors that are worth more than the interest rate differential in pure dollars. Behavioral economics has made it very clear that humans are not perfectly rational financial actors. The version of you that feels financially secure tends to make better long-term money decisions than the version carrying debt guilt. That is not soft advice. That is data-backed reality. So here's how to factor it in. If paying off gray zone debt aggressively would genuinely relieve enough stress to improve your financial behavior elsewhere, lean toward paying it faster. If you can compartmentalize debt and invest consistently without it affecting your behavior, lean toward the investing side. Know yourself. The best financial plan is the one you can actually stick to. Now, let's pull all of this together into a concrete strategy. We are calling it the hybrid waterfall. Money flows from one priority to the next in order, like water moving downhill. You work through each step before moving to the next. Step 1. Build a small emergency fund. First, set aside at least 1 month of essential expenses in a high-yield savings account. In 2026, many high-yield savings accounts are still offering annual yields in the 4 to 4.5% range. Your emergency money should be working while it waits. This buffer keeps you from going deeper into debt every time an unexpected expense hits. Without it, your investment plan gets disrupted by life constantly. Step 2. Capture the full 401k employer match. As we covered, this is free money with an instant return that nothing else can compete with. Step 3. Eliminate all high-interest debt. Any debt above roughly 9% gets paid off aggressively before you invest beyond the 401k match. This includes all credit card balances, store credit accounts, and any high-rate personal loans. This is the highest guaranteed return available in your financial life right now. Step 4. Fully fund your emergency reserve. Once the toxic debt is cleared, build your cushion up to 3 to 6 months of essential expenses. This protects your investments from being interrupted every time something unexpected comes up in life. Step 5. Maximize tax-advantaged investing. Contribute to your Roth IRA or traditional IRA up to the annual limit. For 2026, that limit is $7,000 for people under 50 and $8,000 for people 50 and over. Then maximize your 401k contributions above and beyond the employer match. The tax savings from these accounts effectively boost your real return. Step 6. Apply the gray zone framework to any remaining mid-range debt. At this stage, you're likely looking at a mortgage, a modest auto loan, or federal student loans. Use the 60-40 split we discussed and adjust the ratio based on where your debt rate falls. Let's look at a concrete example with real math. You are 30 years old with a $6,000 credit card balance at 21% APR and $400 extra per month available. Option 1. You invest the $400 monthly in an S&P 500 index fund and make only minimum credit card payments. Assuming 10% average annual returns, after 20 years, your investment account looks impressive on paper, but your credit card, at minimum payments alone, takes over a decade to pay off and costs thousands in interest. Your net position is being eaten away from the other direction the entire time. Option 2. You put the full $400 toward your credit card every month. At that rate, you eliminate the $6,000 balance in about 16 months. Then you redirect the entire $400 into investments for the remaining 18+ years. Your investment account grows on essentially the same timeline, but you are no longer bleeding 21% annually in the opposite direction. The net outcome is meaningfully better. The math is not even close. Knowing the framework is step 1. Not making the classic follow-up mistakes is step 2. Mistake number 1. They pay off all their debt and then do not invest. Once the debt is gone, that payment amount has to immediately pivot into investing. People who clear their credit cards and do not redirect the money within a few weeks tend to inflate their lifestyle instead. Set up the automatic investment transfer before the debt is even fully paid off. Mistake number 2. They raid their investment accounts to pay off debt. Withdrawing from a 401k early triggers income taxes plus a 10% early withdrawal penalty. On a $10,000 withdrawal, you could lose $2,500 to $3,500 immediately to taxes and penalties alone. You are creating a new financial problem to solve the existing one. Mistake number 3. They forget to account for tax-advantaged accounts in the comparison. A 10% return inside a Roth IRA grows completely tax-free, which makes it worth more than a 10% return in a taxable brokerage account. Factor this into your math when deciding whether to invest versus pay down gray zone debt. The Roth advantage tips the scale toward investing more often than people realize. Everything we have covered today is a framework, and frameworks only work if the mindset behind them is right. The most important shift you can make is to stop seeing debt payoff and investing as competing priorities. They are both forms of building net worth. Paying off a 21% credit card increases your net worth by exactly the same amount as earning 21% on an investment of the same size. Your net worth is not just the stack of assets you have accumulated. It is assets minus liabilities. Every dollar of high-interest debt you eliminate is a dollar your net worth gains permanently and unconditionally. The people who build real wealth over time are not the ones who timed the market perfectly. They are the ones who understood the full picture, eliminated the math working against them, and systematically built up the math working for them. Here's what we want you to do before this video is over. Write down every single debt you have. Next to each one, the interest rate. That is your entire starting point. Compare each rate to the long-term S&P 500 average of approximately 10%. Anything above 9 to 10% is your top priority before investing. Anything below 5% and investing likely wins. Everything in between, use the hybrid waterfall. If you do not know the interest rate on one of your debts, that is the first problem to solve. Call your lender or log into your account. Pull the statement. You cannot make an intelligent financial decision about something you have not measured. The one number that changes everything has to actually be a number, you know. Let's recap what we covered today. The debt versus invest question does not have a universal answer. It has a personalized answer that depends on one number: your debt's interest rate compared to your expected investment return. Credit card debt at 21% in 2026. Pay it off first. No debate. Federal student loans at 6.4%. Gray zone. Investing while making standard payments is defensible. Mortgage below 5%. Invest. Full stop. Always capture your 401k match. Build your emergency fund. Eliminate high-interest debt aggressively. Maximize tax-advantaged accounts. Apply the 60-40 split in the gray zone. Follow the waterfall in order, and you will be in a better financial position than the vast majority of people who are just guessing at this question. If this video helped you see your financial picture more clearly, that is exactly what the Wealth Metrics is here for. Subscribe for more content like this, share it with someone who is wrestling with the same question, and we will see you in the next one.